Hello and welcome to Chapter 13, Part 1. In this chapter, we're going to be talking about what's called cost allocation. We have to allocate the cost of anything that has a life of longer than 1 year because we're going to spread that cost over the useful life of the asset. So cost allocation uses the matching principle from back when we talked first about the principles that financial accounting is based on, GAAP financial accounting anyway. And we want to match the cost of our assets to the time they're used to generate income. So the matching principle says if we're using a machine to generate income over the course of 5 years, we want to take the cost of that machine and apply it to the years that to each of the years that we're generating income with the machine. So that's the concept. So how do we do that? This is something that you know probably as depreciation, or at least you think you know it. It's as depreciation. If you look up depreciation in the dictionary, it's going to tell you that what it means is a decrease in value. But that's not the definition that accountants use. Accountants don't look at decrease in value, though that's certainly occurring. They look at how do I apply the cost of this asset, which occurs on day one when I purchase the asset, to the years that it's going to be generating revenue. So I want to match that year one cost across the years that it's going to generate revenue. So the graphic that you see here, you've got your cost in year one, you're getting dollars of benefit in each of the 4 years, so you're going to allocate the cost across those 4 years. So when you're thinking about cost allocation, the first thing you need to know is what's the valuation. Then we need to know, so what's the cost? And figuring out what cost is sometimes is a little more difficult than you think it might be. How are we using it? Are we using it over the period of a number of years? So how many years will it be useful for? Or also, how fast are we using it during those years? And how much is it contributing to revenue during those years? So we want to use that matching principle, match the cost to the revenue. These are just some terms. Depreciation, depletion, and amortization basically mean the same thing within the accounting profession, but they're applied to different assets. So depreciation is what we call that allocation of cost, but just for tangible assets, things that you can touch. So property, plant, and equipment are depreciated. Natural resources like oil, gas, and coal are depleted. It means the same thing, taking the cost of the asset and allocating it across the useful life of the asset. So we deplete natural resources, and then intangible assets, so things like patents and other intangibles, franchises. There are lots of different kinds of intangible assets. Intangible assets are amortized, and it once again means the same thing, allocating the cost over the useful life. So as an accountant, if you start talking to me about amortization, I know you're talking about intangibles. If you talk about depreciation, I know you're talking about tangibles. And if you talk about depletion, I know you're talking about natural resources. So those are jargon words that are used by accountants, and good to know the difference between the different definitions. So if we think about property, plant, and equipment, that would be land and land improvements, building, equipment, and natural resources. Oh, natural resources shouldn't be there. Oh, look at that. Let's fix that. Those are natural resources are tangible, but they are not considered part of property, plant, and equipment. But tangible assets have a physical substance, you can touch them. And then intangible assets include things like patents, trademarks, copyrights, franchises, and goodwill. And they lack physical substance. They're intellectual property is another word that's used for them, but accountants call them intangible assets. So property, plant, and equipment, what I said you have to determine the cost. The cost of property, plant, and equipment is called the cost of that asset and everything necessary to get that asset ready for use. So if I'm buying a piece of property, a piece of equipment, and I have to install it in my factory, and I have to bring in some different kind of power to run it, say 440 instead of 220, and I have to reinforce the floor because it's so heavy, then those costs of reinforcing the floor and bringing in the power and doing the installation become part of the cost of the asset, because I couldn't use the asset until I did those things. So everything necessary to get the asset ready to use. So if you look at this list here, my cost, the cost that will show up on the balance sheet for a piece of machinery is the purchase price. If it is subject to sales tax, the sales tax will be added to that purchase price. Shipping, so if I have to freight, the freight necessary to get it to where I need it will be added. The insurance that I pay while it's in transit will be part of the cost. Any assembly, installation, and testing necessary, and then any legal fees that might be incurred to establish title. All of those things become the cost of the item. Things that don't become a cost are recurring costs. So insurance, once it's in place and ready to use, property taxes that I pay annually on the cost of the asset or the value of the asset to local government, those things get expensed along with maintenance costs like oil and lubricating oils and things like that. Those all are period costs or recurring costs, and they get expensed. They don't get included as part of the cost of the asset. So some terminology. These are terms that you need to know. Accumulated depreciation is a contra asset. That's the first time you've heard that term. It's a negative asset. So when we present property, plant, and equipment on the balance sheet, we show the property, plant, and equipment at its historical cost, what we paid for it. And then we have a separate account that's called accumulated depreciation that shows all the depreciation we've taken to date. So if it's a 3-year-old machine, accumulated depreciation will include all of the depreciation from year 1, 2, and 3. The net of the two gives you what's called book value. And book value is the net value of the equipment on my books. So I have my cost, and then I have my accumulated depreciation, and cost minus accumulated depreciation equals book value. Service life, it's an estimate of how long we expect this to last, and in order to compute my depreciation, I need to know what my service life will be, and it's an estimate, so it could be wrong. But we think this machine is going to last 5 years. That's a service life estimate. And generally speaking, for most tangible assets, even when its service life or useful life is over for us, it still has some value, and we can probably sell it for something. So if you think about a car, I might decide to keep this pickup truck in my business for 5 years, but when the 5 years is over, it still has some value, and I can sell it for that residual value. So in order to compute depreciation, I'm going to need to know what the service life is and what the residual value is. So those are two important things. And remember, those are estimates, and generally speaking, estimates can be wrong. So we make the best estimate we can about how long the machine is going to last, and we make the best estimate we can about what the value will be at the end of its useful life to us. GAAP allows 3 different methods of cost allocation for tangible property, and then requires a single method for intangible property, and then a different single method for natural resources. So straight line depreciation is one of the 3 methods that we can use for tangible assets. And straight line is pretty easy to understand. We'll go through it in a second, but it's just taking the cost of the asset, the net cost after salvage value, and dividing it by the number of years we expect it to last, and we charge the same amount of costs to each one of those periods. So that's straight line. It's, as I said, an option for tangible assets, but you have to use straight line on intangible assets. So amortization is always straight line. There is no choice. GAAP says it's straight line allocation. Accelerated depreciation is an option for the depreciation of tangible assets. There are lots of different acceptable methods, and I'm not going to teach you the acceptable methods, but basically the concept of accelerated depreciation is that tangible assets are more useful when they're younger. So they produce more when they're new than they do when they're old. So therefore, we take a higher, we allocate more of their cost to their early years and less of their cost to later years, because we expect that they will produce more revenue in their earlier years than in their later years. So that's acceptable for tangible assets. It's not acceptable for any other kind of assets. So you can use accelerated depreciation for property, plant, and equipment, but you can't use it for anything else. And then finally, activity-based cost allocation is an option for the depreciation of tangible assets. It's required for the depletion of natural resources. So activity-based basically says, I expect my truck not to last 5 years, but to last 200,000 miles. This year I drove it 50,000 miles, so I'm going to allocate 25% or 50 over 200 of the cost of the asset to this year. Next year I drive it 100,000 miles, so I'm going to allocate 50% of its cost, and the following year I only drive 10,000 miles, so I'm going to allocate a smaller amount. So we look at what we expect the life of the asset to be, and in terms of units or production, and then we look at how much of that life we've used each year. So I'm going to go through this as and show you the calculations for that, probably in the second half of this lecture. So the thing about these methods of cost allocation is they give us 3 different answers for tangible assets, and it's a choice. It's a choice by management what method to use. So we can use straight line, and here's an example, just an example of a machine that costs $25,000. It has an estimated useful life of 5 years. We expect the value at the end of 5 years, the residual value, to be $2,000. And we expect that it will be useful for 5,000 hours. So this might be an engine, could be anything, but cost of the machine. So straight line depreciation, we're going to take 25,000 minus the 2,000, so it comes to 23,000, and we're going to allocate that $23,000 net cost over 5 years, and that comes to $4,600 a year. Pretty simple. Accelerated, and I use the double declining balance method. I'm not going to teach you that method or require you to know it. There are several different accelerated methods. But accelerated depreciation using double declining balance gives us a first year depreciation of 10,000, a second year depreciation of 6,000, and then a straight line depreciation from year 3 on of 2333. The total is still 23,000. We've charged the costs in different years, which means that we have front-weighted the depreciation to the early years, because that's when we think the product is going to be the machine is going to be most useful or most productive. And then the final method, we kept track of the hours the machine was used, and it was used 500 hours in the first year and 1,000 in the second year, and so forth. And we just calculate the activity-based depreciation using that metric. So it's good for 5,000 hours, so 10% of, if we use it for 500, that's 10%. So we're going to record $2,300 in the first year, and so forth. Once again, we end up with $23,000 being allocated. So the overall depreciation for these 3 methods is the same. It's just the pace of those depreciation methods. So you get 3 different methods, you get 3 different yearly answers. So the point of this is when you look at the financial statements, as I'm starting to ask you to do with Kirby, and we'll go into more depth with other companies shortly, you need to know what kind of depreciation they're using before you can evaluate or compare, at least compare them to other companies that might be in the same business. One company using accelerated and another company using straight line will get very different answers for the same assets. So important to know, important to understand. So your formula for straight line is the cost of the asset, which includes everything necessary to get it ready to use, minus the estimated residual value divided by the estimated asset service life. So an equal amount each year. I'm going to go on here now and give you an example of one asset and how it's how the different ways we might allocate that cost. And the asset is sort of a favorite of mine. I really like these things. This is an orange juice machine. When you take a whole orange unskinned, put it in the top of the machine, and hold your glass under the spout at the bottom of the machine, and out comes fresh squeezed orange juice. So it takes the orange, it splits it, it squeezes it, it throws away the skins, and gives you the fresh squeezed orange juice. My first experience with this was in a hotel that had, breakfast service. It happened to be in Europe, and I was like, I was enamored of it. I think the hotel lost money on me being there because I drank so much orange juice. It was just terrific. The picture in this slide here is actually a machine right here in Maine, in Port Clyde, at the general store in Port Clyde, where they have one of these machines. And I just took a picture of it because I thought, I can use this with my explanation of depreciation methods. So let's take an example. We have in January of 2003, a juice machine was purchased for $11,500 in cash. And they do actually cost that much. They cost close to that if you look them up online. They cost a lot of money. So if you want a good grade in this class, you can always go out and buy me a orange juice machine, and maybe I'll bump your grade a little bit. But not true, but would be pretty good to get an orange juice machine for the house. So it was purchased for $11,500. The equipment has an estimated useful life of 6 years and an estimated residual value of $500. Delivery and installation costs are $1,000. So what's the annual straight line depreciation rate? Well, first of all, we have to establish the cost. The cost is going to be $11,500 plus the delivery and installation, which is $1,000. So the total cost is $12,500. And remember, the formula for straight line is cost minus residual value divided by estimated useful life. So 12,500 divided by 500 minus 500 divided by 6 years should give you my straight line depreciation. So there's your straight line depreciation. Cost minus residual value gives you your life in years. 12,500 minus 500 divided by 6. To depreciate this machine, I'm going to allocate $2,000 of depreciation each year. So that's my depreciation expense using straight line. So now let's look at units of production. So I said this is a valid method for tangible assets. It's also required for natural resources. So we'll get into the natural resources later, but this is a required method for natural resources. So same information, 11,500, 6-year life, residual value of 500, and delivery and installation costs are 1,000. But here we have one more piece of information. This machine, over its useful life, can squeeze 240,000 glasses of juice. So we need to calculate how this machine will be depreciated, and the first thing we need to do is how much to depreciate each time we squeeze one glass. So if we take the 12,500 minus $500 residual value and divide it by $240,000, we're going to come up with a per glass depreciation rate. And then down below it tells you first year we squeezed 36,000 glasses. So we multiply that depreciation rate times 36,000 and we get an answer. So that looks like this. Depreciation rate, cost minus salvage value, 12,000 divided by 240,000 is 5 cents per glass. So we're going to, every time somebody squeezes a glass of juice, we're going to depreciate the machine 5 cents. Now that's only part of the cost of the juice. That's the machine cost of the juice, and we still have to pay for the oranges, and then we have to pay somebody to clean the machine occasionally and that sort of thing, and we have to provide the electricity for the machine. So the cost per glass is quite a bit higher than that, but that's the machine, the allocation of the cost of the machine per glass. So when Professor Shaughnessy was in the hotel drinking orange juice at a great rate, he was costing a nickel a glass, perhaps, plus all of the other period costs, the oranges and the cleaning and the electricity and all that. At any rate, the depreciation for year one then will be 5 cents times 36,000 glasses, or $1,800. So that's a production or activity-based method. So hopefully that's useful. I didn't go through the accelerated method because I'm not going to ask you to learn it, but accelerated methods, there are lots of different ones that are acceptable, but they basically move the cost of the asset, more of the cost of the asset, to the beginning of life of the asset instead of the end of the life of the asset. If you have any questions on any of this, I know I'm going relatively rapidly. If you have any questions on any of this, certainly shoot me an email, and I'll be happy to further try to explain it to you. So other things that happen related to this are something you got to understand. So when we replace the motor in a large machine, is that a repair? Do we expense it, or do we capitalize it and depreciate it? And there's a simple rule. If the replacement lengthens the life of the asset or makes it more useful, it should be capitalized. So let's give an example. Let me give you an example. If I have a truck and it's supposed to last 5 years, let's say, and in the 4th year, I decide to repower it, to put in a new engine. And by repowering the truck, I extend its life to 7 years instead of 5 years. Then that's a capitalizable event. I'm putting a new engine in. It's going to make the truck last longer. So therefore, I'm going to take the cost of the new engine and spread it over the remaining useful life, which will be year 4 through year 7. So I'll depreciate it over those 3 years because I've extended the life. The flip side of that is if I take that same truck and I don't put a new engine in it, it's going to last 5 years. It's year 3, and I decide I'd really like to have a dump body on this truck. So I put a dump body on the truck, so it now becomes a dump truck. That costs something, but it also makes the truck more useful. I can generate more revenue with this truck because I have a dump body on it. So therefore, I'm going to take the cost of the dump body and depreciate it over the remaining useful life of the asset, which is still 5 years. So I'm going to depreciate the dump body over year 3, 4, and 5 over 3 years. So those are the two sort of things. Now, if I put new tires on my truck, that doesn't do anything to make it last longer, and it doesn't make it more useful. All it does is make it usable because my old tires were worn out. So therefore, that's an expensed item. I'm not making it more useful, and I'm not extending its life. Same would be true of changing the oil or putting in new air filters, or those are maintenance items, and those get expensed because they don't extend life and they don't make the truck more useful. So those are just some basic rules for capitalizing or not capitalizing items. This is a graphic that shows the same thing. Expensive repairs just maintain the given level of benefits. Capitalize if they extend useful life. And I think the next graphic is capitalize because they increase rather than maintain future benefits and depreciate over the remaining life. So that's kind of a wrap up of this section of chapter 13. There'll be another section for you to do after you've answered the questions on this one. So the recap, capital assets are things that are going to last longer than a year. We want to allocate those costs over the useful life, which is an example of the matching principle, because we want to match the cost of the asset with the revenue that it generates. 3 methods of allocation for tangible assets, which is what we've talked about so far. We'll get on to intangibles in the next section. So straight line, production or activity-based method, and various accelerated methods. And there are 3 kinds of assets, and we've just really talked about one, the tangible assets. We'll talk about the other 2 in the next section. So talk to you later. Thank you.